Right then, folks, it is Friday and we are at the end of another week of trading on a pretty negative week all around for stock indexes, which we'll have a look at now in a second. We'll break down the calendar, but you can see widespread equity weakness, which has accelerated towards the back end of this week. But you can see the S&P, the Dow Jones, the Nasdaq, and the Russell all cruising lower and continuing on their downtrends. You can see the DAX, the Euro stocks, the FTSE, everything has just been sold over the course of this week. You can see the Aussie, Kiwi, Euro, and Sterling all pushing lower. Sterling, I mean, it's gonna close lower, but probably will close lower in relation to where it opened, but Sterling's held firm against the US dollar strength, but dollar Swiss, dollar CAD, and dollar yen all pushing higher, and obviously then the dollar index then following with it. But sterling relatively strong over the course of this week, which we'll have a look at again when we get around to the economic calendar. That has coincided with upside in bond yields, which have reversed over the course of today, but has not stopped the sell-off in equities. But bond yields continuing to push higher over the course of this week as well, and gold continuing on its downtrend in line with yields higher and that broad-based US dollar strength. Now, that's the expected reaction you'd expect to see. I mean, if you got equity weakness across the board and you got US dollar strength across the board, that is what you would expect to see off the back of some sort of hawkish commentary, or some sort of higher than anticipated economic data, which will cause interest rates to rise, or in the case of the current situation, to remain higher for a bit longer than markets had anticipated. That has coincided, as I said, with yields higher, which driven likely due to the fact, or not likely, it has been driven over the course of this week by these FOMC minutes. But if we just go back a little bit earlier than that and have a look through the calendar for the week, China for the last number of weeks and months has been under pressure, and the economy has not been performing the way that people will have hoped post their COVID lockdown that ended maybe about a year ago. From now, you can see industrial production then figures on Tuesday. Consensus 4.4, but below consensus. You can see retail sales, consumer spending below consensus. You can see the unemployment rate rising. You can see fixed asset investment, which is investment into things like real estate, which is again below consensus and below previous. So negative Chinese data continues into this week. House price index, prices of homes in China again continuing to be weak, and really there is nothing positive coming out of China at the moment, which obviously is the world's second largest economy and does dent the global economy's continuing recovery, or does dent the global economy's hopes of avoiding a recession off the back of all these interest rate hikes. Then you couple that with the minutes that we had on Wednesday, the Fed suggesting that some of the participants wanted to keep rates the same, but most of them agreed that maybe more tightening ahead would be appropriate, suggesting that early next year, markets had priced in, or were pricing in the hopes for an interest rate cut at some point early next year. But now there is a stance from the Fed. They continue to stick to the stance that there is significant upside risks to inflation, and interest rates are going to have to stay at a restrictive level for longer than markets had anticipated. Now, all those things together, when you think about the Fed, potentially looking at hiking rates again this year, or markets starting to wake up to the fact that the Fed may potentially hike interest rates again this year, and then they're not going to cut them for longer than they had a hope for. That again further increases the chances of a potential recession. Couple that with China, just negative numbers across the board, no matter where you look in China. That again is a further risk to the global economy, which is the reason for stock index downside across the board. These bond yields lower over the back end of yesterday and into today is an interesting move. Now, that has not stopped the losses in equities. You'd expect, with the way markets have moved and the way these bond yields have trended, these pushing higher have been negative for stocks. Expectations for interest rates to either move higher or be held at a higher level for a longer period of time. That is negative for stocks, but this bit of downside in yields has not proved any sort of respite for stocks. Longer that continues lower, if that's a safe haven play and people are purchasing bonds off a bit of a safety net, and that is further negative for stocks, that is not good. Right, that is not good at all, and that seems what is happening over the back end of this week. Apart from that, I've had some UK data out this morning. Retail sales negative, as you can see. Retail sales negative, which has been negative for sterling over the course of this morning's session. But if you come back, reason for sterling holding firm over the course of this week was this somewhat sticky inflation print. You can see headline inflation figure in line with consensus, but core CPI a little bit above consensus. The CPI for the month of July also slightly above consensus. Now that means that the central bank will need to keep the foot on the gas, or potentially need to keep the foot on the gas in terms of interest rate hikes to come, when the rest of the major central banks are seemingly reluctant to continue hiking rates further. If rates do go further higher in the UK, which they more than likely will, that continues to be supportive for sterling, which is why we have seen sterling hold firm while the rest of these currencies sell off versus the US dollar. We also did have some Japanese, I don't seem to have it on here, we did have some Japanese inflation this morning. If we come back around to it, CPI consensus 2.5, actual 3.3, so a big beat on inflation in Japan this morning. You can see the consensus 3.1, actual 3.1 in terms of the core CPI print, which did come down slightly, but the total rate of inflation, once you include food and fuel costs, Japan having no oil themselves, they've got to import all of their oil, import all of their fuel. Prices of that rises. It is a negative for the for the economy. But once you think everything taking into consideration, inflation in Japan has struggled for a number of years, for a long time. They've struggled to gather any sort of inflation. If inflation continues to trend higher, continues to push higher, that means that the central bank have something to think about in terms of adjusting monetary policy, which that contributing factor to a bit of Japanese yen strength. But with those yields pushing lower and equities remaining under pressure, has proved somewhat supportive for the Japanese yen over the last 24 hours. So if these yields continue to push lower, right, if these yields continue to push lower and they get through these lows on the 10-year, and equity markets continue to remain under pressure, there's a lot of positions that need to be unwinded on dollar yen, and I think that's a trade going into next week to keep an eye on. Keep an eye on those yields. If those yields continue to push lower, stock indexes remain under pressure, dollar yen becomes a good sell up at these levels, in my opinion. But that's it then. That's a bit of a wrap up for the week. We'll be back next week with a number of videos. We'll have a week ahead on Monday, and then we will update further on markets as and when we come to it. But have a good weekend, enjoy it, recharge the batteries, get some rest and relaxation, and we'll be back next week for another week of trading.